Hello everyone and welcome to today's video. Today I am talking about capital gains tax, and in the previous two videos we looked at rental income and the basics of that and also the tax consequences, and in there I was talking about capital gains tax, what happens if you sell a property. But before we get into that, my name is Andre Botma. I make tax videos here on YouTube about SARS e-filing, how to use that, tax tutorials, and teaching everybody the tax principles in South Africa. So if you're new here, consider subscribing. So one of the first things to cover about capital gains tax is, when does a capital gains tax event actually happen? And in tax, when you study tax, you learn about the difference between what is a revenue item in the tax books and what is a capital item in a tax books. In general, a revenue item will form part of either your expenses or your gross income, and it's basically like trading stock. When you sell trading stock, you sell it regularly on a high frequency, you sell it often and maybe a lot of quantity of it, and it generates income. So when you have revenue, that is also referred to as income. However, the difference between revenue and capital is more things like assets. It's like the vehicle of a company. So if a company's got motor vehicles that it uses, a company might also have a building, or you as an individual, you have shares or a property. Those are all assets. They're also considered capital because you don't sell them on a high frequency. You don't sell them often. Unless you're a property trader, then property actually becomes part of your trading stock, and then that is revenue. When you sell property every now and then, it's actually an asset. It's a capital gain transaction. Also, an item that is considered capital, we refer to that as often it is an income producing asset. And so that's also a nice phrase. Income producing asset, it produces an income. So a rental property, that is the asset. So when you sell it, there's capital gains tax. However, the income that it generates is the rental income. And so that is taxed as a revenue item. And so also, just a good idea or something to keep in mind of is, when you look at a tree produces fruit. And so the property produces the rental income. So when you sell the tree, there will be capital gains tax, but when you sell the fruit, there will be revenue. So that's the difference between a revenue item and a capital item for tax purposes. So the common capital gains, or the most common capital gains for individuals specifically, is two things. One is the sale of shares, and number two is the sale of property, or immovable property to be more specific. And normally this will happen when you sell, maybe you've got unit trusts, maybe you own single shares through a share broker. Maybe you have a share portfolio with, for example, Allan Gray or Coronation, or you've got a portfolio with your financial planner. And so there could be a capital gains tax event. However, also if you have shares in private companies, when you sell them, there's also a capital gain event there. The second capital gain event, and this one I think is most common, is when you sell your property. Now, the two most common properties people will sell is either they've got a rental property which they sell, or their primary residence. And so there's a special primary residence exclusion when you sell that property. So those are the two common capital gains tax for individuals. So when we look at capital gains tax, the two most important terms there would be proceeds and base cost. And in simple terms, proceeds are simply what you're selling that asset for, what you're getting for it. And the base cost is what you paid for when you purchased it the first time. However, obviously with tax, it's not as simple as that. And so there's many things that's included in base cost, and there are some things that's included in proceeds, and we will look at that in another video. So when you calculate whether you've got a capital gain or capital loss, you've got a capital gain event when the proceeds, what you get for selling your property, is more than what you paid for it. So simple math, proceeds minus base cost. If the base cost is less than proceeds, that will be a capital gain. However, if the base cost is more than the proceeds, then that will be a capital loss. One thing to keep in mind is when you have a capital loss, it does not reduce your taxable income. Instead, it gets carried over to the next tax year. So a capital loss can only reduce your capital gain. It can't reduce your taxable income. So that's important. And then the last point is this is just an example from the rental income video. There's a house, proceeds that I'm selling it for is 2 million. The base cost is 1 million, so the gain that I'm getting is 1 million. However, because I'm an individual, the inclusion rate, coming up in the next video, is 40% for an individual. My tax rate might be on a sliding scale of 18 to 45%, and so the marginal rate of tax for the capital gain is going to be 7.2 up to 18%, and so the maximum capital gains tax I can ever pay on that capital gain is 180,000. So it's going to be somewhere between 72,000 and 180,000 rand in capital gains tax. Okay, so that was the basics of capital gains, and this is a introductory video. So in the next video, I will talk about how to actually calculate a capital gain tax event. And to spice things up a bit, I'll talk about both primary residence and also when you sell a rental property, and also what happens if you had the property for a period as your primary residence and then you moved out and then you rented out the property and then you sold it. Okay, so that's in the next video. Thank you for watching. I'll see you in the next one.